So good afternoon, everyone. Welcome to the final session. Congratulations for staying around until the very end. I'm Ben Rose, partner at Norton Rose Fulbright here in Singapore, where I lead the Asian shipping and offshore energy practice. I'm delighted to be moderating this panel session on the title theme of the conference, Navigating a Strong Market, Capital Allocation in a Period of Abundance. So this theme and the conference comes at a time, as we've heard, when shipping companies have amassed a significant amount of dry powder, but are equally being faced with a number of challenges: environmental, regulatory, geopolitical, and security risks and challenges. And so strategic decisions being made now by owners and financiers are going to be critical in determining future success. So in this session, we're going to be looking at the choices on how to utilize capital between investing in new projects or deleveraging existing ones, or indeed whether to build cash reserves or distribute capital to shareholders. So we're fortunate to have a distinguished panel, or part of a panel, of experts who will bring a wealth of expertise and experience from different perspectives from within the industry. So to my left, we have Ted Young, CFO of Dorian LPG, one of the world's largest LPG vessel owners with a fleet of modern VLGCs. Alan assures me that he'll be here in 5 minutes. I'll introduce him anyway. Alan Hatton will be here, Managing Director of Foreguard Shipping, and owner and operator, smaller owner and operator of chemical tankers and anchor handlers. We then have Zhang Chunqi, Deputy General Manager of Business Development and Operations Department of Seacon Shipping Group, an owner of dry bulk and oil and chemical tankers, as well as a provider of management services. And then we have Amy Chow, Managing Director of Transportation Finance at Standard Chartered Bank. So I'll ask the questions to individual panelists, but perhaps we can, feel free to counter what other panelists say and to add your own perspectives at the end of someone's answer. So I'll start off then with Ted, perhaps. Given the high interest rate environment over the past couple of years, but this strong market and strong cash flow position that you've been enjoying, how has that affected your decisions on capital allocation between paying down debt, investing in new vessels, returning cash to shareholders through dividends or share buybacks? Effectively, how are you balancing your short-term financial performance with your longer-term strategic goals?
Yeah, it's obviously pretty topical. Our interest cost we fixed a long time ago, and so as we sit here today, our all-in interest cost is about 4.67%. So paying down debt has not been a priority, just because ours is pretty cheap. It's long dated, and we're with the few facilities we have that have covenants, we're well in compliance. So really, the decision that our management team and board has been faced with, which is a high-class problem, is do we pay dividends or do we invest in the fleet? And given the history of the sector, we had 3 tough years in the VLGC sector, 16, 17, 18. And when we started generating real cash flow in 2021, we elected to start paying dividends. We had done stock buybacks. They'd had no measurable impact on our total shareholder return. We did a self-tender offer. We bought back about 13% of the company at a price of $12.50 a share, which we weren't sure was brilliant at the time, but when the stock traded up to 50, we obviously looked really smart, but better to be lucky than good. We have found that paying dividends has really brought the best results for our shareholders and our total shareholder return. So for the time being, We're trying to balance between rewarding our shareholders and slowly but surely looking at a fleet renewal. And we sort of can't do one without the other, because if we were to eliminate our dividend, which would obviously increase our cash position, our cost of equity would skyrocket, and we don't want to have that happen. So we've been sort of carefully looking at new buildings, looking at secondhand tonnages, and continuing to pay dividends.
Yeah, okay, thanks. I mean, I don't know if anyone else wanted to comment, or perhaps we could look. You said that interest rates have not had much of an impact, but I was hoping to ask some of you what you thought that the environment over the next couple of years, with interest rates coming down, inflation likely to ease off, if that's going to affect your strategic priorities at all, and are you more likely or less likely to be investing in new assets or prepaying debt? And Chunqi, perhaps I could put that question to you, or indeed Ted, you can.
Yeah, I think in our fleet we have fixed some long-term charter in the high-rate environment. So this will be an advantage for our future cash flow, because the rate is relatively high from the fixed charter rate. So I think for the short term, from my point of view, we are more focusing on floating rates financing. So I think for maybe the next term we will do some swap to lock our cost in the future. But we're more fond of floating rates. Yeah.
And I mean, the other, I suppose, factor is that currently new building prices have been high, and second-hand prices high. But now, I guess, clearly, they're not perhaps the time to invest. But Ted, you mentioned in the next couple of years, perhaps you might look to deploy extra capital in renewing or extending, adding to the existing fleet.
Yeah, I think that's right, and I think that's exactly the conundrum I think a lot of us in the room faced. I think Georg said it pretty well in the last panel, though, that marshaling your capital and waiting for the right time in the market is probably the advisable strategy. I think most of us know that in shipping you have to get the buy right. If you don't get the buy right, you're going to have a really long time really hard struggle to make your money back on the ship. And so from our perspective, we don't have the ability, because we're a public company, just to sit on our hands, and the investors are going to start looking at our $350 million cash pile and want to get their hands on it. But on the other hand, we don't want to invest at the wrong point in the cycle. So that's why we're sort of taking a measured approach to doing it. But with a fleet that's still quite young but getting older every day, it's a strategic priority for us to do. And so I think we're sort of, to use the American baseball term, waiting for our pitch. But of course, you can wait too long and miss the opportunity. So that's really the balance of what we're trying to strike, and really what we discuss as a management team, day to day, week to week, and we talk with our board about all the time. And I wish we had a crystal ball, but we don't. So we'll continue to try to balance the various priorities and make our best bet.
And Chunqi is the same. For you, are you looking at the prices coming down for new builds anytime soon, and planning to invest in new vessels?
I think Seacon is quite bullish on the new building market even today. So that's why we have expanded our fleet rapidly since the second half of last year. And now we have 30 new building orders in hand, and with 30 vessels on water, and we are selling some old vessels. So our average fleet until 2026 will be younger than, I think, 3 years. So it's quite a new fleet now. And we're still quite bullish, but not only because of the lack of slots, but also because of the tight capacity of the suppliers. And we can see there are many giant orders in the future, but we bit slowing down now, and our mindset is we are trying to find some niche market, and with the old fleet and the new design maybe more competitive. So we are still following this mindset to find niche opportunities to invest. And as a third-party management, we also have very flexible cooperation structures with the partners, because what we can bring to the JVs or the partners is we can control the cost when facing the downturn of the shipping market. And I think with the JV structure, we can maybe lower the capex because we don't need to have such a very high leverage. And I think with the same faith in the same sector, we can, together with our partners, we can keep calm when the market going down. So as a investment department of my company, I'm trying to build links with more and more partners, and that's some ways to fight against the high, or we can say the high price of the new building price. Yeah.
Okay, and sorry, Amy, I've not come to you yet, but to get a lender financier's view. What trends have you been seeing over the past couple of years? I mean, Ted was saying that actually the high interest rate environment has not really affected them that much, but I was sitting in on Kevin's presentation this morning, and he was talking about the sheer amount of prepayments that have been going on, kind of offsetting the bank's lending. That's also, a high level of lending. So what have you seen, and how are you advising your clients to kind of balance their debt management versus kind of investment opportunities?
I think it's all of the above, what Ted and Chunqi mentioned. I think when I see the trends across ship owners, I will see it from two parts of it against two macro backdrop. One is I've seen ship owners is thinking about how should I get ready for the next interest rates cycle, downward cycle. And the next, with a strong market, how do I get ready to better capture profitability in such strong markets, right? I've seen various trends, ship owners placing investments in fleet optimization. In that, it includes new buildings, even though, depending on whether you ordered 5 years ago, 3 years ago, or now, the price might be different. The strategy in investing in second-hand is different as well. And when we talk about investments, it's not just about vessels, right? There's the EST, the efficiency, ship technologies. I think all these are very important, especially from adapting your fleet to future-proof your fleet. And of course, with a strong market, I mean, we have seen a lot of prepayment, ship owners reserving some of the cash balance to reduce the debt, and whilst retaining part of it from a refinancing, whilst capitalizing with with this interest rates, right? And of course, we talk about the last 4 or 5 years, markets were really strong, but we forgot. Further down, 10 years ago, shipping markets has been not doing that well. I think making dividend payments and share buybacks, I think it's equally important as well to build the credibility within the stakeholders. That is perhaps the most important stakeholders that one should manage across the up and down cycle, right? Maybe I'll just give one more point about interest rates, since I'm a banker, right? I think everyone is a little bit relieved about what the Feds did last week, this week, cutting 50 basis points. Very good. Everyone is looking on a downward slope. Maybe we can hold off the staring a little bit, but perhaps I would quote what Christine Lagarde, president of ECB, said last week in press. to say that we have all experienced the worst pandemic since the 1920s, the worst conflict in Europe since 1940s, and probably one of the worst energy shock since 1940s. So what I'm trying to say is that economic cycle is getting shorter. Just because it's coming down today, it doesn't mean that it's going to be rosy. With technological advancements, AI, market to speed, and how central bank intervening on policies, shortening recessions, and the same policies could trigger a new cycle. So I think all this needs to be in our minds when making decisions on whether it's a good cycle. That's a lot goes into the evaluation as well. Yeah.
Okay, thanks. I guess this may be a tiny bit off subject, but while I was talking about Kevin's presentation and slides this morning, he obviously showed the slide which shows the shift, quite a dramatic shift in financing techniques, which I guess have been employed by ship owners. And the massive rise in operating finance leases, and of course the Chinese market, and then JOLCO's equity versus the sort of traditional debt financing. Do you think? I'll stick with Amy first of all, I suppose, and get the banker's view. Do you think that's a short-term shift, or is this a long-term change in the market?
I could be wrong, but my view is I don't think it's a structural shift. I think decarbonization, ESG, is a structural shift to the industry. I think these financing techniques is about how quickly ship owners or the industry adapt to the market dynamics when interest rates go high, when you have more cash, then what do you mix and match your financing solutions to achieve the optimal mix, right? Bankers likes to use the word to say what's the most efficient capital structure applies to a ship owner. So, in this very high interest rates environment, for example, JOLCO equity becomes very attractive because obviously that is very expensive, right? Me being a commercial bank, I still think, yes, JOLCO equity capital markets is attractive compared to traditional bank. Even if you raise equity issuance, it's attractive, right? I think traditional bank continues to be attractive from a longer term perspective. Now, yes, you have to pay a little bit more interest payment, but I think it's very important, again, for ship owners to have a good diversification on your financing mix, and especially from banks who have a good track record in supporting the ups and the downs. So liquidity is important, and it's even more important when the market is not ready for the liquidity.
Yeah, I'd say from a borrower's perspective, I think the interesting thing about the emergence of all the different financing structures has been that the traditional commercial banks have actually gotten, I think, a little more creative and a little more thoughtful about more bespoke structures. So, for the longest time, it was, don't talk to me about anything other than a 5-year loan, and, whether it's going to be a 15 or 16-year profile, we'll see, and, we can talk about the margin. And now I think we're seeing, I know in the U.S. we've got a lot of the banks are doing structures where, effectively it's a revolver with a amortizing profile, so you can reborrow some of the money you pay back, which adds financial flexibility. We did a 7-year traditional bank deal back in 22, which was fantastic. We were able to go back and ask for an amendment for some more favorable terms. Which was great for us, maybe not for the bank, but it was reflective of the market where they know they're facing more competition, and with all this liquidity available, I've seen the banks I think be more creative and more responsive to traditional ship owner needs.
And do you guys see? Let's take Chinese leasing as here, and we've talked about current vessel values being pretty high. Chinese leasing being done with very high leverage. You know, what happens when vessel prices start to fall? You know, I've been around in this industry since 1999, I think, and, you know, seen a few cycles, and we all kind of know what happens in that situation. So do you see this being a big impact on the Chinese leasing sector in particular? Anyone? This is not a prepared question, so any of you guys can feel free to answer.
Hello. Yes. Firstly, sorry for being a bit late. I think the post F1 roadworks added to my ton miles a little bit there on the way here. Going back to the point, I think, about financing structures and different types of financing first, if you don't mind. I mean, I've been in an interesting position because I was running a leasing business before, which ended up being a lender of last resort before we took it over. And then subsequent to that, we've done some quite interesting and innovative financing structures in both Japan, Korea, and other places, different things, because really out of necessity, because I think we fly below the radar of the big banks. We're not on the map in terms of being able to go to the top names and borrow as a Maersk or BW would, or as, you know, other esteemed panelists would be able to. So we've had to be creative, and we've had to push structures as well as the financiers. In terms of your point now, it's what's always interesting is the availability of money, and the fact that when you really need it and really want it, it's not there. And when you don't need it, suddenly everyone wants to give it to you. And that's where we're kind of at the moment. You know, that's added to the inflation. You look at the dislocation of yard prices and input costs at this point in time. There's no reason for those prices to be as high as they are, apart from demand and apart from the fact that the yards are full. This is a cyclical industry. I don't think there's going to be anyone too surprised to see the cycle come to an end at some point in time. And when the music stops, you get left holding, you know, your position. And if you've over leveraged yourself, or you've borrowed or lent too much into a market at a certain price, you know, that's down to your risk management.
Yeah, and I mean, as it relates to Chinese leasing, you know, I don't know, but they're not going to be the only ones left holding the bag. You know, the tradition. Okay, the commercial banks obviously kind of all learned their lesson from 2008, and you know, it's a very different environment, but. You know, it seems to me from a banking perspective, not my world, obviously Amy's, but when you know, some of these brilliant deals some of these banks did in 2012, you know, say they were lending 60%, you know, loan to value, which was quite racy, but on a dry bulk value that was, you know, near all-time lows. So as the values increased, the loans automatically deleveraged. The regulators were happy, senior management was happy, and we had a virtuous cycle. You know, kind of Alan's point, we're probably coming to the other side of that hill. So we'll see what happens. But you know, undoubtedly, when you've you know, leveraged it to perfection, it usually is going to go wrong at some point.
Yeah, I think Chinese leasing. So where I'm come from CMB leasing. So I worked there for 10 years. And I think they have already learned their lesson on the last cycle. So they made some financing in maybe 2011 to 2013, and some clients go bankrupt in 2016 to 2018, and they take back the vessels because leasing structure, they can turn the lease asset to their own asset as an operating lease, and they have this tools to wait. They have the time. They have enough cash in hand. So I think from their perspective, they don't worry about it because they already have this capability to deal with it in the last cycle. So, but from a borrower perspective, we just try to balance our cash flow, and we're trying to, as I spoke earlier, we're trying to find some niche market to make our finance. Yeah.
Okay, thanks. So let's maybe move on to market volatility. I'll give Alan a chance to answer some questions. So as we've all heard, the market is strong, and yet we're also living in this kind of world of geopolitical and geoeconomic uncertainty, the supply chain disruptions, you know, wars in the Middle East and Ukraine. There's canal disruptions. There's energy crisis, pandemics. How do you build resilience into your operation, or how do you build capacity to deal with the next, short-term black swan events, but also, prepare for longer-term challenges, or indeed, the next downturn?
Well, look, I think Amy touched on it before. I mean, I think if you look at what's happened and the things that have caused the most significant effects in our markets across the board in shipping haven't been a tight order book, haven't been demand and supply fundamentals, it's been a pandemic, it's been outbreak of war in Ukraine, it's been the Red Sea. These things have had a huge, huge effect on the market, far greater than all of the fundamentals that are underlying it. So I think you cannot run a company at this point in time without paying reference and heed to those potential issues, and that more could come. But I also think you just need to build everything in the way that you would otherwise, and you need to be adaptable, you need to be flexible, you need to reduce your costs when you can, you need to focus on building your capital structure in the right way, delivering when you can, all of those different things that you would do normally. I think you just have to be very prepared for changes that could come very, very quickly, and that you really don't understand, quite how cataclysmic the effect could be.
I guess, Ted, I mean, LPG market has, seen its share of volatility, I guess. So sort of same, how do you, structure your capital deployment strategy to withstand these kind of market swings?
Yeah, I mean, the best defense for a volatile market is a low cash cost per day. That's what we all live and die by. So, I control the balance sheet part of it, so it's my job to make sure that the interest and principal payments are manageable. It's incumbent on my operating colleagues to keep our OPEX, and our G&A in line, because, look, we can all look at the historical charts. So we know that in the VLGC world that, okay, the last 15 years have been pretty good, about $40,000 a day. The last 10 years even better, about $45,000 a day. But, one standard deviation is probably, $26,000 a day. So, when you look at, setting up your cash cost per day, that's probably a pretty good number to be at or below. And so, that's number one. Number two is obviously maintain more cash than you probably think you need. And as a public company, that gets tricky because everybody sees your numbers every quarter and says you should give us that money back. With the, and they're sort of saying, oh yeah, we'll be there if you need us. And of course they won't be when, the market's terrible. That's just life. And then, I think the other thing is, all the other, tricks that all of us keep up our sleeves, an unencumbered asset, unused credit lines, all those good things, because, in shipping, when it rains, it pours. But if you've kind of got those 3 lines of defense, 4 lines of defense, you've got a pretty good shot at surviving.
And Amy, from a bank's perspective, again, I mean, in this kind of cyclical market that we're all in, I mean, how do banks prepare for the next downturn, or indeed, how do you, advise your clients to prepare for the next downturn?
I think banks generally constantly look at their portfolio. I think one of the ways to defend the portfolio has always been diversification. Vessel segments would be a good start, as in the cycles should be relatively different. And I mean, vessel segments is one, having a good mix between spot 1 or 2 years charter and long-term charter in terms of cash flow diversification mix is another lens to look at the portfolio. I think above all, perhaps client selection would be top of the list. I think I know a lot of banks, including ourselves, love to focus on big, large companies with a large balance sheet and all that. I think it does. I mean, balance sheet resilience to a very large extent does gives comfort to bank. But I would also like to say that we have seen mid-sized companies with good market and financial discipline who has demonstrated that they could do the job as well. So I think it's really back to client vessel segments and some employment mix, if you like. Yeah.
Yeah, I mean, why don't I turn to Chunqi? Amy, you mentioned diversification. Perhaps it's, I guess, Chunqi, perhaps you are the most diversified in terms of at least vessel makeup of your fleet. So what role do you think diversification plays in this kind of, current strong market, but also in terms of protecting you from the next stress event or downturn?
Yeah, I think from a banker's perspective, the diversification not only means in the shipping market for different ship types, they also have many choices. They can do the airplanes, they can do infrastructure. So I think the spirit of diversification from the financiers is always with them. But for our ship owners or in the shipping sector, we only can focusing on the value chain of the shipping. So as a third-party management company, we will brought a very good cash flow in the light asset services such as supervision, third-party management, shipping services, and maybe some commercial capability. And for the heavy asset side, we are trying to balance our wet and dry at this stage, and we have half and half now, including our new building orders. And we are also trying to we also pay a lot of attention on the PCTC and gas, and we're trying to do them, but now the price is in the top, so it's not a good time to form such projects now. Yeah.
I don't know, Ted or Alan, you wanted to comment on Amy's point on diversification, or harder perhaps for you to do, and Alan as well, because you were not here earlier on. You might also want to comment about, what your current plans and thoughts are towards allocating capital towards new investments, expanding your fleet.
Okay. Well, on the diversification point, I think it's always seen to be, and it has been proven to be a good idea to diversify and to spread risk across various different segments and sectors. The only thing with that is that isn't always what your stakeholders want you to do. And an awful lot of people, certainly if you're running listed companies, the trend has always been pure play and let the investors pick their blend of different pure plays to get their own diversification in that respect. In terms of where we are and our capital allocation and everything else, and apologies, I wasn't here to answer it earlier. I think the way that we're looking at the market at the moment is that everything looks quite expensive and quite risky in the segments that we're focused on. And while we'll look at deploying capital in a kind of allocative, efficient way, if it's accretive, if things look good and look interesting, we would do that. But I don't think we're running to the yards to put in orders for ships that could come in 3 years or 4 years or something like that, which don't benefit from the market today. I think we'd much rather look at things on the water. We'd much rather look at locking in and having access to the market as it is at the moment, because we feel that is justifiable. If you can, even if you're paying a lot for a second-hand ship at the moment, at least you're getting access to 3 years probably of decent rates, and then you can look at where your residual is, and it's much easier to assess that risk rather than an open-ended risk of a new ship that comes in 3 or 4 years. But generally, I think there's no shame in the position that we find ourselves in, which is we made some good bets. Those bets are solid, and we're in no rush to throw good money after those deals. So we'll wait and see.
Yeah, I think that makes a lot of sense. And I guess what I'd add, look, the allure of diversification is that the sectors aren't correlated, but this entire conference has all been about how all markets are doing well. So it might be a bit of a fool's paradise to think that some will stay up and others will go down. That's a tricky bet to make. So and also look, as a public company, our investors certainly encourage us to stick to our knitting, and they can diversify better than we can, because we may love Supermaxes, but they'll just go buy Pacific guys up in Hong Kong. They can diversify better. They may not like it as much as we do. So that's usually a pretty good argument for sticking to what you do, manage the volatility of your own cycle, which presumably you're going to understand better, and harvest your gains when you can.
Yeah, thanks. I guess, like, as a final topic, we're probably going to have to touch upon ESG, environmental and decarbonization, in terms of how you guys allocate capital. So why don't I'll ask Ted. I know you didn't really want to talk about ESG, but how do you, adapt to the kind of tightening environmental regulations and I guess maintain competitiveness while you have these, short-term costs, but long-term environmental and sustainability goals?
Yeah, I mean, I guess, look, the short answer is we all know what we have to do. And the Poseidon Principal banks, kind of make the argument that we better regulate ourselves before somebody else does it for us. So there's some logic there. I think ESG is pretty broad. So looking at, the E piece, there's actually a solid investment case for a lot of these things. I've been very pleasantly surprised. I mean, we made fantastic money on our scrubbers, far better than we ever could have imagined. We've made nice money on these expensive, silicone paints, right? The fuel savings has been pretty fantastic. Muse ducts, all this kind of stuff, which are not big dollars, but the returns have been really nice. And of course, it reduces our carbon footprint and it makes, ensures we're not going to have to derate our engines, do whatever else the regulators dream up. But I think over the longer term, there's obviously a broader discussion to be had about, can governments' desire to meet these increasingly aggressive, net zero dates really match up with the science, the underlying science and technology? And, if they don't, is shipping going to get lost in the shuffle? No, because we're not going to get displaced by anything. I mean, so much trade moves on vessels that people in this room control. So eventually there'll have to be a loosening of those regulations if those indeed become the case. And also, if we get forced to make uneconomic investments, it will destroy our industry. And I think hopefully cooler heads will prevail over time.
Yeah, and Alan, I mean, well, Ted was talking about technological innovation. What about things like digitization and automation in terms of improving, operational efficiency to maintain your competitive edge, rather than this just being, a cost that you need to make?
Yeah, I mean, I think all of these things have their place. I mean, I think it depends on your trade and the way in which your ships move. I mean, certainly for a small player like us in a niche market, as we are, and Foreguard is chemical tanker focused, for those that don't know, it's for us, our investment, if you like, in technology and all of this is much more about retrofitting, is much more about energy saving devices in the yard, is much more about just trying to get those incremental benefits, and so better paints, painting the propeller, all kinds of things like that. We don't think that much at this point about automation or digitization in terms of the trades that we do. But then again, we have commercial managers and technical managers that do think about those things. And I think they absolutely have their place. I think anything that can drive efficiency has to be important. And I think, to Ted's point, I think the main thing here is, as long as there is a financial benefit of doing these things, it's going to come to fruition. If it can give you a competitive edge, if it can make you more efficient, it'll come.
And Amy, from a bank's point of view, these, looking at the risks and challenges, I guess, of investing in new fuels and propulsion systems, new technologies, how important is that to you as a lender? How are those risks being managed, and how important do you see or how do you see these impacting or having a net positive impact on your customers' balance sheets?
I think we are definitely supportive, be it investments for vessel efficiencies, be it ESTs, new fuel propulsion. Of course, the level of pricing is a very major topic that goes into every ship owner consideration. And there's lots of considerations about availability of fuel, infrastructure, and all that. Really, from a banker's perspective, we are quite thankful we are not the ship owner who manages this problem in a very direct way. But I think what we would like to see or discuss with our clients perhaps is whether our clients have think through every single risk and reward. I mean, of course, it's in life, in business, it's always about the risk and the reward, right? And as long as we know, have we done the right calculation on return of investment? Have we thought about what's the payback period? Is that the type of residual value or risk appetite the company is able to take? And what about hedging strategies against charter rates, right? If the investment kind of you are not able to charter to the level of rate or to the customers that you expect it to, is there a fallback, right? I think all this needs to come into that. And as long as considerations are done and it kind of fits in, it doesn't need to be a fantastic number, and as long as it's within that risk tolerance level, I think yes, I think it's always something that we are open to consider.
Okay, I think we're run out of time, but it's always good to end with an open question. So why don't I ask all of the panelists, what are maybe some of the things that you could be doing that you're not currently doing, whether that is towards technology, environment, capital allocation? I'll leave it open to you to answer. Why don't we start with Chunqi? Why don't you go first?
Yeah, I think what we could be doing, so from an investor perspective, just follow the last topic. So we are trying to form some new projects on the battery vessels, but I think from the financiers and our ship owners, we are a little bit passive on these ESG or new technology investment because the charterers or the end users doesn't reflect the charter rates, so the calculations is very hard for us. But for the battery vessels or the electric vessels, we are a Chinese company, so China has very strong battery industry now, and the government has spent a lot of money on the infrastructure for the rechargeable stations alongside the Yangtze River, and the ports are also very keen to make investment on this sector. So we also pay a lot of attention on the development on this sector. And as a ship owner or a third-party management company, we are more or less act as a follower, not a pioneer, because our core business is third-party management. So, but we stay close to these new trends and as well as the IT development. So that's what we can do, and let's wait and see what will happen in the future. Yeah, thank you.
Thanks. Ted, a couple of words?
Yeah, I think probably where I see the biggest opportunity within our business is some day-to-day operational improvements. I mean, look, I think we do a good job running our ships and everything else, but our business is more complex, and I think we're just starting now to take a more critical look and do the proverbial re-engineering and examine why we do things a certain way. Can we do them better and more efficiently? And I think that's going to yield savings. So I think we need to do more of that and probably do it faster.
I think I'm going to work on my calendar alerts first. I think that's the first thing I'm going to do. I think the beauty of running a private company now, having run public companies in the past, is that really we can do what we decide we want to do, and we don't have to do things just for the sake of doing it or to keep size or to keep market share. I think the one thing that is interesting at the moment is to try and work out. We can see everything's quite toppy from both an asset and freight rate perspective. There's some dislocation there on those, and they don't always kind of tie up. But are there ways of creating a more resilient earning stream, getting yourself into the cost rather than just the profit? And so we're looking at various different things that we could do around that going forward, I think. Not just looking at playing on rates or asset values, and actually looking at trying to get more resilient long-term earning streams together.
And Amy, I don't know if you wanted to finish off either with things that you could be doing differently or that you think your clients should be doing differently.
No, I thought you asked me a question just now that what could I have done differently. I would like to say I would like to charge my client more. But anyway, that's a discussion for another day.
We all would. Okay, we're out of time, so thanks very much to the panelists, to Marine Money, and thanks to you all.